Imagine a woman, 58 years old, sitting at her desk when her phone rings. The caller tells her that her father, 84 years old, has fallen at home. He has just been released from the hospital, but the doctors have made it clear that he can no longer safely live alone. Over the next 48 hours, she will have to make one of the hardest decisions of her life for her family. At the same time, without realizing it, she is about to become a customer of an industry worth more than $400 billion in the United States. That industry is called assisted living. In this video, we are going to walk through the internal economics of that industry, step by step, and explain why some owners build steady, highly profitable businesses while others go bankrupt within just a few years. Because this industry is not, as it first appears, a simple business of renting out real estate and providing basic care. It sits at the intersection of three completely different forces: demographic change, government regulation, and human resource management, and that intersection makes it a remarkably complex financial system. Let's start with the numbers, because they explain why this industry looks so appealing. In the United States, the generation known as baby boomers, more than 70 million people born between 1946 and 1964, is now approaching 80 years old in massive numbers. This demographic wave creates a level of demand never seen before in history. But the important point here isn't just the number of people. The modern assisted living model, unlike the traditional nursing home concept older generations are familiar with, offers residents far more independence and a much higher quality of living. This difference makes the choice psychologically more acceptable for families because they feel they are moving their parent into a comfortable home, not a hospital-like institution. As a result, demand keeps rising at a rapid pace, but the number of newly built facilities simply cannot keep pace with that speed. This exact imbalance is the opportunity entrepreneurs see in this industry. Before entering this industry, the business model you choose shapes almost every decision that follows. The first model is the small, home-style residential care home. It typically houses 6 to 10 residents. The property is often an adapted residential house and the startup capital required is relatively low. The second model is the mid-size, purpose-built facility. Resident counts here typically range from 16 to 49, and this already requires serious construction work and a far more complex licensing process. The third model is the large corporate scale complex. These facilities can house more than 50 residents, sometimes hundreds, with full clinical staff, restaurant level dining service, and organized activity programs. The difference between these three models is not simply size. Each one requires a completely different capital structure, a different risk profile, and a different profit mechanism. The small model is more flexible to manage but misses out on the advantages of economies of scale. The large model demands enormous upfront capital, but once it reaches full occupancy, it becomes a remarkably stable and predictable revenue engine. Let's start with a 6-bed, home-style facility, since this is the most common entry point for new owners. Monthly resident fees, depending on the region, range from $4,000 to $7,000, with a national median of around $5,500 for a single room. A fully occupied 6-resident home can generate somewhere between $27,000 and $33,000 a month in total revenue. But that is gross revenue, and it does not reflect the real picture. On the cost side, staffing is the biggest line item since 24-hour, 7-day coverage is required, which means multiple staff shifts. Add to that food costs, utilities, insurance, state licensing fees, and rent or mortgage payment. Real financial modeling shows that a 6-bed facility's monthly profit can range anywhere from a negative $1,500 to a positive $8,000, and that wide range comes down almost entirely to occupancy level and how tightly costs are managed. This is the industry's first major lesson. Two facilities of identical size can produce completely different financial outcomes purely based on the quality of management tool. In California, mid-sized facilities licensed as RCFEs, residential care facilities for the elderly, housing 16 to 49 residents, tell a different story. A facility like this can generate annual gross revenue somewhere between $600,000 and $1.5 million. Well-managed facilities achieve a net profit margin in the range of 10 to 20% of gross revenue, which translates to $60,000 to $300,000 a year in net profit. Here is an important nuance. In absolute dollars, this is far higher than the small homestyle model, but as a percentage, the margin stays roughly similar. The reason is straightforward. As scale increases, fixed costs like management, accounting, and marketing get spread across more residents and shrink proportionally. But labor costs continue to grow almost in direct proportion to revenue because caregiving is fundamentally a human labor service with very limited room for automation. Many people think of this industry's revenue as simply a monthly resident fee, but the real revenue model actually consists of three separate layers. The first layer is the base rent. This covers living space, utilities, and basic services, and typically runs $2,500 to $6,000 a month. The second layer is the care service fee. This applies to residents who need help with daily activities, such as bathing, dressing, and medication management, and it adds $500 to $3,000 a month, scaling up as a resident's needs increase. The third layer is additional services, transportation, housekeeping, laundry, and wellness programs, all billed separately and generating extra revenue. Some facilities also charge a one-time entrance fee ranging from $1,000 to $5,000, covering administrative costs and an initial health assessment. The most profitable facilities never rely on the first layer alone. They actively promote and sell the second and third layers because that is where the bulk of real profit margin actually comes from. The startup capital required to open a mid-sized facility grows very quickly. Furniture and equipment for resident rooms can cost $300,000 to $700,000. Medical and safety equipment, emergency call systems, defibrillators, specialized medical beds adds another $100,000 to $300,000. Building a commercial kitchen and dining room can cost $200,000 to $500,000. Marketing and opening costs are typically projected at $50,000 to $100,000. On top of all this, it is recommended to keep $200,000 to $500,000 in working capital in reserve before opening to cover daily operating costs until the facility reaches full occupancy. First-year payroll alone for a mid-sized facility with 30 to 50 employees can run $500,000 to $1.5 million. Add all of this together and a mid-sized facility becomes a multi-million-dollar undertaking, a scale that simply cannot be compared to a food truck or a coffee shop covered in our earlier videos. At the largest scale, the numbers move into an entirely different league. For a full-service, large residential complex, land acquisition alone can cost $5 million, and construction costs can reach $30 million. At this scale, the monthly mortgage payment can run up to $120,000, a financial obligation that begins months before the first resident ever walks through the door. At this level, cash flow stays negative throughout construction and often continues negative for a period after opening until occupancy reaches a critical threshold. This is the industry's biggest paradox. The highest potential profit is directly proportional to the highest startup risk. Clinical staffing costs typically start at around 28% of revenue and tend to climb further over the course of the year, since minimum wage increases and labor shortages hit this industry directly. This staff includes nurses, caregivers, cooks, cleaning staff, and administrative personnel. This industry has a defining characteristic. Service must continue 24 hours a day, 7 days a week, with no close hours whatsoever. That means a minimum 3-shift staffing system with enough coverage on every shift, including sick leave and vacation coverage. When an employee leaves, a replacement has to be found, background checked, properly certified, and trained. That process takes real time, and during that period, remaining staff must pick up additional shifts, which creates fatigue and can lead to declining service quality. High staff turnover in this industry is not simply a financial problem, it's a serious issue that directly affects resident safety. If there is only one number to remember from this video, it should be occupancy rate. There is a widely accepted principle in this industry. Once occupancy drops below roughly 85%, profit erodes very quickly because fixed costs, rent, core staffing, and utilities continue regardless of whether the facility is full. Every time a resident leaves, whether due to death, moving in with family, or transferring to another facility, every day that bed sits empty represents a direct net loss. The average resident stay in this industry runs 18 to 24 months. That means maintaining occupancy requires a constant, uninterrupted effort to attract new residents. Not a one-time marketing campaign, but an ongoing process. Some industry experts describe this as constantly trying to keep a half-empty airplane full. Except this particular airplane never actually lands. On its own, a significant cost center. Within the industry, resident acquisition costs, marketing, sales staff, and referral fees paid to agencies can reach as much as 40% of revenue in the early years, especially for newly opened or partially occupied facilities. That is a far higher number than most people expect, and many new owners underestimate it when building their budget. The reason is simple. Families do not make the decision to move a loved one into a facility quickly. It is usually a months-long, emotionally difficult decision process involving multiple visits, comparisons, and negotiations. This extended cycle significantly lengthens the sales process and raises the value of every successful conversion. A cost category that looks relatively minor at first glance actually has a major financial impact: food costs. Industry financial models show that without careful menu and portion management, food costs can consume 65 to 70% of the revenue generated by dining services. That is far higher than the roughly 30% food cost ratio typical in the restaurant industry. The reason is that there is essentially no freedom of choice here. Every resident must be served 3 meals a day tailored to their individual dietary requirements, which leaves far less room for cost-efficient menu planning than a restaurant enjoys. Insurance carries an entirely different weight in this industry compared to a restaurant or a food truck. Residents are vulnerable, often in fragile health, and a single fall, a medication error, or one moment of inattention can result in serious injury or death. This level of risk makes it necessary to carry a range of expensive insurance policies, from general liability coverage to professional negligence insurance. On top of that, every state has its own licensing agency that conducts regular inspections, and any violation, from understaffing to documentation errors, can result in fines, a temporary suspension of the license, or even complete closure of the facility. Within this industry, memory care units specialized for Alzheimer's disease and other forms of dementia occupy a unique position. This service sells at a higher price point than standard care, typically an additional $1,000 to $2,000 a month, because it requires a higher staff-to-resident ratio, specialized security measures such as secured, monitored areas, and specialized staff training. Despite these added costs, this service usually results in a higher profit margin. Because demand for it remains remarkably stable, families are far more willing to pay extra for their loved one's safety. Forward-thinking facility owners who add a small memory care unit alongside a standard assisted living wing can significantly boost the overall profit margin of the entire facility. Financing, where this much capital actually comes from, faced with a startup capital requirement running into the millions, the natural question is, where does this money come from? For large projects, the most common path is a combination of a commercial real estate loan and private investor capital. The owner typically provides 20 to 30% of the total project value themselves, with the remainder financed through a bank loan or investors. For smaller, home-style facilities, Small Business Administration loans, SBA loans, are widely used, since the real estate itself can serve as collateral. Some owners choose an entirely different strategy, buying an existing facility instead of building new. This approach eliminates construction risk entirely and means acquiring a facility that is already licensed and possibly already partially occupied, naturally at a higher purchase price. This industry is subject to even more regional variation than the food truck industry we covered in an earlier video. Every state has its own licensing agency, its own minimum staff-to-resident ratio requirements, and its own building codes. In states like California, regulation is particularly strict. Obtaining an RCFE license can sometimes take years, accompanied by regular inspections and rigorous documentation requirements. In other states, the process is comparatively simple. Beyond that, market demand also varies regionally. Sunny, warm climate states like Florida and Arizona traditionally see high demand since they are popular retirement destinations, but for that same reason, competition there is also considerably fiercer. Before entering a new market, it is essential to carefully research not just demographics, but the existing competitive landscape and the local regulatory environment. A difficult quarter scenario. To see the real risk behind these numbers, let's walk through a specific scenario. At a mid-sized facility, 3 residents leave within a single quarter, either moving in with family or passing away, and occupancy drops from 90% to 78%. In that same period, 2 experienced caregivers resign, and the resulting gaps are filled with overtime at 1.5 times the normal hourly rate. During a state inspection, a minor documentation violation is discovered, requiring a correction plan and a follow-up inspection, which adds administrative time and cost. The marketing budget for finding new residents is doubled since every empty bed represents an ongoing daily loss. None of this is individually catastrophic, but together it can wipe out an entire quarter's profit and even eat significantly into cash reserves built up over previous months. National chains operating in this industry hold several structural advantages that small independent facilities simply do not have. This includes centralized purchasing, where food and medical supplies are bought in bulk at lower prices. Shared administrative services, accounting, legal counsel, and information technology are distributed across multiple facilities, improving cost efficiency. And a nationally recognized brand significantly shortens the sales cycle, since families are more inclined to choose a name they already trust. A small independent facility, by contrast, must pay full price for every expense and manage every crisis entirely on its own. The difference, again, comes down to scale. A chain can absorb the losses of one underperforming facility using the revenue of dozens of others, while an independent owner has no such safety net. Why some owners succeed while others go bankrupt. The line between success and failure in this industry usually comes down to 3 key factors. First, occupancy management. Successful owners treat marketing not as a one-time opening campaign, but as an ongoing process. They maintain continuous relationships with local hospitals, physicians, and social workers so that the flow of new residents never completely stops. Second, managing staff turnover. Facilities that offer competitive wages, a clear career growth path, and a supportive work environment achieve lower turnover, higher service quality, and consequently, higher occupancy. Third, full utilization of revenue layers. Facilities that rely solely on base rent inevitably fall behind competitors who actively promote and sell the second and third revenue layers, care services, and additional services. Let's take a mid-sized facility with 30 residents generating roughly $1.8 million a year in revenue and follow 2 different owners. Optimized scenario. The owner builds strong relationships with local hospitals and physicians before opening, consistently keeps occupancy above 90%, offers competitive wages to reduce staff turnover, actively sells care services and additional services, and starts operations with sufficient working capital in reserve. The result, a net profit margin of 18 to 20%, translating to $320,000 to $360,000 in annual net profit. Realistic scenario. The owner treats marketing as a one-time opening campaign. Occupancy fluctuates between 75 and 80%. Staff turnover remains high. Overtime costs significantly exceed budget. The business relies solely on base rent, and additional revenue layers go largely unused. The result, a net profit margin of 5 to 8%, translating to just $90,000 to $100,000 to $40,000 a year, a relatively low return given the scale of responsibility and risk involved. The gap between these 2 owners, operating facilities of identical size with identical starting capital, comes to roughly $200,000 to $230,000 a year, and that gap is decided almost entirely by decisions around occupancy management, staff stability, and full utilization of revenue layers. Closing. Let's return to that first phone call, a 58-year-old woman searching for the right decision for her father. For her, this is not simply a business choice, it is a deeply personal and emotional family decision. But on the other side of that same call, from the facility owner's perspective, this is an entire financial system, occupancy rate, staff turnover, revenue layers, insurance risk, and regulatory compliance, all balanced together in a complex equilibrium. This industry is genuinely growing fast, and demographic reality makes that growth inevitable. But operating in a growing market does not automatically mean success. A coffee shop's core risk lives in its lease. A food truck's risk lives in its permits. An assisted living facility's risk lives simultaneously in 3 places: every empty bed, every departing employee, and every small detail that slips through the cracks of oversight. Owners who reach scale and maintain management quality do not simply earn money, they build a lasting, trustworthy institution serving people during one of the most vulnerable periods of their lives. Owners who fail to do this often end up losing both things at once: financial success and public trust.
Thank you for watching. If you enjoyed this video,
Don't forget to subscribe to the channel to support us.